Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome to another episode of the What Matters podcast. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And today we're thrilled to have Thomas Ruggie joining us. Thomas is the founder and CEO of Destiny Wealth Partners, an independent RIA out of Tavares, Florida, also conducting business as Destiny Family Office, Ruggie Wealth Management, KCG Investment Advisory Services, and Nichols Wealth Partners. Welcome, Thomas.
Thank you, Mike. It's a pleasure to be here. And it's Ruggie, but
Ruggie. I apologize.
No fret. Everybody, it's Ruggie or Ruggie to everybody else. So,
well, with a last name like Mershazadeh, it got butchered so many times.
I'm sure.
I should have known better.
Well, it's fantastic to have you join us today here, Tom. You have over 30 years of experience in the industry. You began working in the financial industry back in 1991, if I'm not mistaken. And then 2 years later, founded Ruggie Wealth Management. Could you walk us through your journey from founding Ruggie Wealth and then to establishing Destiny Family Office in 2016, was it?
Yes. Yeah. And it is a little bit of a journey. So I started in the business right out of college and actually was hired by a company to do quote unquote financial planning. And being young and naive, it took me a month or so to realize they really wanted me selling life insurance. And so to their credit, we put financial plans together for everybody, but the end result was always looking to sell a life insurance policy. The good part about that is that planning component has always carried forward with me, through the business. But I did start in 1991, started Ruggie Wealth, what is now Ruggie Wealth, started that January 1st of 1995. So my fourth year in the business, or at the end of my fourth year in the business. And, really why I wanted to go out on my own is I didn't really know it at the time, but I certainly have an entrepreneurial streak and like being my own boss, like making my own decisions. But also, as I grew the first 4 years in the financial advisory world, I realized that I wanted to provide unbiased advice, and working for a company pushing products to me wasn't accomplishing what I wanted. So set up our own firm around 1998. We transitioned to be a primarily fee only. I was accustomed to not having too much money, so it was a pretty easy transition for me to focus about 90% of the business on fees and 10% on more commission based stuff. But within a year or two of building up the assets under management, we were pretty much all fee at that point. So it made the runway fairly easy when we decided to transition. We were on LPL's pilot program to transition to a hybrid between a BD relationship and an RIA. So we set up our RIA. And within a year of doing that, we actually left the BD model completely and became a 100% RIA at that point. And from there, what led to the establishment of Destiny Family Office in 2016 is I'm a long-term strategic coach member and certainly a disciple of what they do. And one of the things that we've always done over the years is have a discussion about what is it you want to do for the rest of your life. And I absolutely love what I do for a living. But I'd gotten to a point where financially, it's a great place to be when you don't have to make a decision based on financial needs. And so what led to the family office was I was sitting there evaluating my business and saying, okay, I'm 48 years old at the time. What is it that I want to do for the next 20 plus years of my career, and who do I want to do it with? And I literally started just making a ledger on a sheet of paper. And after going through that process and reviewing it, it boiled down to, I want to work with people that are very similar to me, which tend to have entrepreneurial streaks. They tend to have been, very successful in what they're doing. But also, I think very importantly to me is they're wound like I am, where even though they are very financially secure, not only does that not keep them from continuing to grow, but my top clients, I think, like myself, probably work harder now that they don't have to than they did when they financially had to.
Right.
And so that's what led to the development of the family office, and again, just focusing on that niche, really focusing on somebody like me.
Well, you know what? If you could tell me a little bit about your business, I see right now, and correct me if I'm wrong, because it's not often our RIA database is correct. You guys have about $1 billion in assets, if I'm not mistaken.
That is
And
correct.
and how's your business model made up there? Are you guys how do I say it? Do you guys have advisors, or do you manage the book yourself? We've seen so many different makeups of how that's operated.
Right.
How
Yeah.
does that work for you guys?
Yeah, so we have a little bit of a bifurcated business. It's Destiny Wealth Partners is the RIA umbrella, but under that is a couple of separate entities, including Ruggie Wealth, including Destiny Family Office, and then we have you mentioned Nichols and KCG. Those were merger and acquisitions that they merged into our firm. But asset wise, you're correct. We crossed $1 billion in July of this year, and
Great.
was very pleased to do that. And yet the comment that I made to everybody that asked me about, hey, how's it feel to be at $1 billion? My response to that is $1 billion isn't what it used to be, because back when I
Right.
used to look at $1 billion under management, that was a huge business. And here we are at $1 billion under management, and we're still a relatively small business with all the aggregation going on in the business. But how we're really set up is about 650 plus million of that is on the traditional wealth management side. We have, as of the end of last quarter, we had 954 households that make that up. And then the family office is about 360 million, which consists of 17 households.
Gotcha. Very interesting. So, speaking a little bit more about your journey there, were there some pivotal moments or experiences that you had that really significantly shaped your approach to wealth management and yourself as an advisor?
Yeah, there's probably a lot, but I mentioned, and I'm not trying to plug Strategic Coach, but I mentioned the coaching program. I think being around other successful entrepreneurs that weren't necessarily in my business was a pivotal factor for me, especially at a younger age. And I talked to a lot of advisors that potentially could be a candidate to join us, and it pretty frequently what comes up in conversations with other advisors is, hey, Tom, I've got 15 or 20 years in the business. I'm managing, 50, 70, 80, $100 million. So I've grown a nice business, but I can't really seem to get to that next level. And I'd say, well, what's the next level for you? What is it you want to do? And almost 100% of the time they look at me and they say, well, I want to be like you. I want my business to look like yours. And my response to them is, well, if you've been doing this for 15 or 20 years and you've got, one or two people assisting you, and you don't have an associate advisor, and you don't have other infrastructure in place to get an awful lot larger, it may be too late. And I think what ends up happening is a lot of advisors they want to look like an entrepreneur and be entrepreneurial, but they don't really have that entrepreneurial streak in them where they're willing to reinvest back into the business.
Right.
I think that's one of the biggest things that I've always done is I've always reinvested back into the business. And I mean, and at this point, it's actually something that we track. We track profit margins, and we track, when are we in a position to go out and bring on, new team members, or when are we in a position to go and get some, add to our tech deck. And so it's a very well thought out process. And if you don't have that in place, and you've been in business 15 or 20 years already, it's going to be very difficult to catch up and try to get there.
Right. To your point there about the individuals that want to be entrepreneurs, but they, in theory, in their heads, they want to, right?
Right.
I have a really good friend. He was managing. He was with Merrill, and he was probably managing about 350 million, right? And essentially, he wanted to break off and go on his own. But he made a move, and I think the move might have been to Goldman. Don't pin me on it. But they paid him like $1.5 million or $1.7 million to make a move to them, right? And he's like, and I said, man, with 350 million, you can go on your own, right? That's a great start. You have one employee, or yeah, well, they offered me this $1.5 million or this $1.7 million. I was like, but you're tied up for the next 9 years, or you have to pay that money back, right? So I think the thing is that it's hard for a lot of individuals to see past that, right? And I know for myself, I've always been somebody, especially when I was younger, I kept my overhead really low, because I always, to me, it wasn't about living the life. It was about, not having a boss. That was ultimately the most important thing for me. So I was going to ask you, was that something that was very important for you? Do you operate a lot better not having somebody telling you, how to allocate your day or how to allocate your business and things like that?
I do. Absolutely. I mean, I'm a certified control freak, so I like being in charge of things. That being said, I feel like I have 3 or 4 women, including my wife, that on an ongoing basis are always telling me what to do with my day. But I've got my actual wife, and I have my work wives that also control me and my schedule. But I still do have the ultimate say, and so that is important. And Mike, your point about the money, I think that's spot on, and I find it hilarious because we've had a couple of merger opportunities, and an advisor will come to me literally with a checklist of here's what I'm looking for in a relationship, and we check all the boxes. Yet at the end of the day, if they're talking to other companies, there's been multiple scenarios where an advisor would say, well, this other firm doesn't check all the boxes, but they're going to pay me more, or they're going to offer me more up front. And so, you said it, you told me initially that it wasn't about the money. It's about all the other factors that to me should be a lot more important than the money. But for a lot of people, it still does boil down to the money. And I've always kind of had a premise that if you do things right and you take care of people, and kind of the golden rule, you treat people how you want to be treated, you're never going to have to worry about money. So, money is not a factor that I think should be, it should be in the equation, but it shouldn't be near the top of the list for anybody, like your buddy that was at Merrill.
Yeah. I agree with you there. And let me ask you this. So with all the, entrepreneurial, I would say opportunities that are in our industry right now, how do you keep your advisors loyal to you, right? So ultimately, there's TAMPs out there that are like, hey, you know what? Why don't you come with us? And you can, you'll get 1099, and they'll give them that hybrid of feeling entrepreneur. They'll give them that hybrid of feeling entrepreneurial, but some of that entrepreneurial where they're not W-2'd, so they make them feel like a little bit more, like they're on their own. And we ran into individuals on podcasts that says that that tell us it's really hard to keep their advisors loyal when they have they have those type of opportunities out there. And I'm wondering if you ran into that.
We haven't really, but I would never say that we're foolproof from that happening to us. But I think things that we do that help to create an environment where that doesn't happen is at least in our being kind of a big fish in a small pond, we have a lot of name recognition. So the majority of the advisors that are affiliated with us, the firm has really had a huge part in building the book of business that they have. I always tell people within our firm, I'm the best salesperson we have, and I'm a terrible salesperson. I'm not a born salesperson. Again, I'm just somebody that's done the right thing long enough that now I'm a good salesperson because I have a following, and I know exactly what to do and how to handle certain situations. And after 32 years, you have a lot of wisdom. But we tend to hire not necessarily on purpose initially, but now it probably is more on purpose. But we tend to hire more relationship-oriented advisors, and I think what keeps them here is number one, we've got a great culture. Number two, I think we do have a fair payout schedule. We also do offer ownership or equity within the firm to advisors, and I think that's a key part. But I also think that the fact of the matter is that that with myself as the leader, but the firm in general, we are just not a content and complacent firm. I mean, we are always doing things to improve where we are, improve our offering, improve our value proposition. And in your example, I don't think that a lot of advisors that potentially would leave our firm to go to a scenario like that, I don't feel that they're going to be in the same situation. And I think that that's, at least for our advisors, I think being in a kind of a family-owned, family-run business, the way that we run it is very meaningful.
Yeah, let me ask you this. How many advisors do you guys have now?
We have 9.
9, okay. And then how many employees total is that?
I believe we're at 30, but 30 give or take, 1 or 2.
Fantastic.
Do you guys just have the one office, or is there several different locations?
No, so we have 3 what I call organic offices in Central Florida. Our main office is in Tavares, which is where I live. But then our Tavares office is almost smack dab in the middle of our 2 other offices. We have an office in the Villages, which I'm sure you all have heard of. Everybody that I tell about the Villages, they always make reference to the one thing that the Villages is really well known for. And then we have our other office is in Winter Park, which is towards Orlando. And then we have 2 offices that are really through our M&A business, which one is in Savannah, Georgia, and the other's in Boca Raton, Florida.
Real cool. And so let me ask you this: what do you guys see as your 5-year plan? Where do you anticipate on being?
So we started. That's a great question, Mike. But we started 5 years ago on a path of a 10-year 10xing our business, and so where that would put us in 5 years from now is, and we're pretty close to being on track. We're not quite on track, but we're certainly within reaching distance of being on track. But where that would put us in the next 5 years is at about $3.5 billion under management. Our revenue would coincide with about $35 million at that point. And there's 3 components that we look at from the goal, which is the assets under management, the revenue, and then finally the profit margin, because we want to keep the profit margin at least at 25%. And I've actually been in a situation before where we had a goal of assets under management, because that's where the bright lights are, in our industry is how much assets are you managing. And so we went out and got a lot of assets, especially in the 401k world, but our revenue wasn't increasing, proportionately, and our profits weren't increasing proportionally. So
Right.
I think it's important to tie those 3 factors together. But that's the plan in 5 years. Separately, I just within the family office have basically mimicked that plan, but that's starting this coming year, 2024, which is a 10-year 10xing what we're doing on the family office side, which would also, just on the family office, would put us at $3.5 billion.
Gotcha. And you mentioned having the various offices. How do you, as a leader, continue to drive innovation within your firm, especially among all the offices? Obviously, you're only one person; you can't be everywhere at once. Any specific, leadership philosophies there?
Well, that's true. I can't be all places at once, but just to put this week in perspective, I was in Naples over the weekend, then I was in Miami and Fort Lauderdale, and then I was in St. Petersburg yesterday, and now I'm back here. So can't be in all places at once, but definitely can make the rounds.
But very close.
Yes. But to answer the question, is as far as innovation goes, another thing that we've done that has had a huge impact on our firm is we've utilized the EOS system through Traction, and so we use that. We have our executive team meets every single Monday, and we go through a very vetted process of planning what are our goals for the quarter, breaking it down, what are our milestones throughout the quarter to get there. So and then we've replicated that through the various lines of the business, so that in some fashion or another, every single member of our team is aware of what our goals are and is tracking that. So I think that's important as starters. And then I think the other thing, and I'll just kind of say where I think we are, is, even at a $1 billion firm, which I still consider to be a relatively small firm, we operate like a much larger firm. I mean, already having the family office in place, I think we're ahead of the curve on that, because that seems to be a thing that a lot of advisory firms are trying to go for now. We have a trust company in place. We have our own alternative investment fund. We have a co-investment fund. We do an awful lot of direct investments, investing in companies such as SpaceX and Reddit and Stripe and Anduril. So we're pretty constantly looking at ways to continue to evolve and improve what we're doing, and I think that helps to keep us on track for where we need to be. Another initiative that we're working on right now is what we're calling a next gen business, and
Real cool.
And where that stems from is, I'm 55 years old. Like I said, I'll probably drop dead doing what I'm doing here in my office. At least that's my hope. But hopefully it's not for quite a long time. But I love what I do, and I love my business, and I want this business to be perpetual. But there is no doubt that as we've done our research into this, which we actually have taken a pretty process-oriented regimen to get us where we want to be on this next gen business. But it didn't take us long to figure out that the way that our current business model is we're not appealing to Gen Y and Gen Z. And so we want to build the infrastructure and build the team to have that as a component of our business, because let's face it, there's, you talk about the wealth transfer that's going to take place to Gen Y and Gen Z, which is significant, but our research also says that there's a lot of very successful, young people out there doing well, making their own money, and as we sit right now, we know we're not attractive to that, to that segment of the population. So looking to cure that as well.
That kind of segues right into the next question I want to ask you about. You guys are rapidly evolving, as is the landscape of wealth management. What is your perspective of the future of the industry, and what emerging trends and technologies do you think that the industry is going to evolve into, to adhere to those new generation of clients?
Ashley, I don't know that I'm smart enough to know what that's going to be in the future. I mean, take AI as an example. I mean, I think that's going to have a huge impact on our business, over both the short term and the long term. But I don't know exactly what that's going to look like. So my mindset is more of be prepared to embrace the changes and adjust and adapt, and not try to fight what those changes are going to be. And I feel historically we've done that. Again, I think a lot of what we've done, we've been ahead of the curve on, as far as kind of going fee only and doing the family office and getting the trust business and doing, we do a significant amount of alternative investments, which I was on a panel yesterday for a conference, and I made comment that the last 6 conferences I've been to, virtually every single session is revolving around AI, alternative investments, and how to take advantage of, a very good potential opportunity in the bond market. But there's has been no traditional, what's going on with the stock market. How should your assets be allocated between small cap and mid cap and international? None of that conversation's coming up. It's all about AI and alternative investments. So again, I think the bottom line answer is to to be cognizant that things are going to change, to try to be on top of what's changing, and to attempt to be ahead of the curve and adjusting to those changes, and just understand you're going to make some mistakes. But I'm a big believer that you kind of get to where you are by making mistakes, and as long as you learn from the mistakes.
And let me ask you this. So this is a question I kind of, like to get everyone's opinion on. So much is going on in the marketplace right now, right? I mean, we can't really look past what's happened with all the money that was lent out during COVID. Um, being that I was in the Ashley and I were formerly in the mortgage industry before my brother and I had partnered with Joe Duran to open up the private equity fund.
Mm-hmm.
And, I remember what were interest rates, Ashley, like 2.25%, 2.5% in 2020, right? And,
yeah. Or lower.
Yeah, or lower.
I refinanced my house at 1.87%.
Okay, here's a little secret that I don't share with very many people. The actual interest rate, with the 10-year being at 0.5%, the actual interest rate was probably close to around 1.75. We basically had to like all hop on this phone call, all of us bankers, all of us mortgage bankers, right? Not the brokers, all of us bankers that were direct to the agencies, Fannie Mae, Ginnie Mae, Freddie Mac, and they said, hey, you know what? We don't want you guys competing with each other right now. And we don't really want to see very many loans written below 2%. So, for those of you guys that are, looking to write 30-year fixed rates below 2%, we highly advise against that. What that meant, we don't know. They said, earn some extra money and don't try to compete with each other for the lowest rate right now. Right. And so inevitably, if we were securitizing a loan at 2.25%, 2.5%, we were making about 500 basis points on the back on that one.
Wow.
Yeah. If you were at 2, and if you were at 3%, I mean, you were getting, there were up to 800-900 basis points getting paid back at around 3%.
Yeah. You were getting like a third in
profit
margin there.
It was absolutely insane. So our big niche, our big niche was we were an FHA lender, and we were, we lent all the way down to 550 FICO scores. So, the difference, it's no difference, right? Like, as the issuer as the bank, it's not like we get paid any different from 550 to 750, right?
Right.
We just have to put in risk-based pricing. So, when we were lending, if somebody's FICO score was called 5.5, I mean, we were given 4.25s, 4.5s, which is exceptional, by the way.
Yeah.
And we were maxed out at 1,100 basis points, and it was just an insane money making time for us, right?
Mm-hmm.
And we shortly sold the company after that, right? And which I'm certainly glad I did, right? But
good for you.
I can
good
tell
timing
you
on that.
With interest rates at 8% right now, or 7.5%, I'd say 7.25% on a 30-year fixed rate. They were at 8% when the 10-year was at 5% a couple months back, or a month back or so. But these are times that we haven't really quite seen in so many years, and we had 40 years of interest rates just doing nothing but going down. What do you see in store for the stock market? What's your economic outlook? Where do you see this going?
Yeah. So as mentioned, I think on the fixed income market, I think that there's, I'm not going to say a once in a lifetime opportunity, but there's certainly a very good opportunity on the fixed income side. On the traditional market side, I think what we're seeing this year could continue to replicate itself some, maybe not to the extent where you have, let's call it 7 stocks that are making up the majority of the earnings of the S&P 500. But I could see it where it's 25 stocks or 50 stocks that are making up the majority. I personally believe that there's just a significant wedge between companies that are embracing what is happening, not just with AI, but technology in general, and how rapidly technology is increasing. And I think there's a lot of companies that either are not embracing or just too large to embrace in a quick enough manner. And the biggest thing that I see happening, and I certainly could be wrong on this, but what I see happening in the traditional market is I think we're going to revert back to it being a stock picker's market. And the days of buying index funds and just having cheap costs of money being invested, I think that's going to be a lot more difficult. So that has us moving more towards not only portfolios that are more stock pickers, but even hedge fund portfolios where not only are they stock picking, but they're also hedging some of the downside And of course, as already mentioned, it has us moving a lot more towards alternative investments, which certainly on the high net worth and ultra high net worth side, there's a big desire and demand for these alternative investments and the private deals that I mentioned. But we're also seeing, what I'm going to call a trickle down effect, where a lot of these investments are starting to get positioned where they can be available towards the mass affluent. And even within our portfolio, for example, that our alternative fund that we established 3 years ago now, we have 13 positions in that fund. Every single position is a QP position. So, to participate in any one of those individual positions, you have to have a investment net worth in excess of $5 million. Yet, by putting all of those into our portfolio, we actually can offer that to accredited investors. So now it's a $1 million investment net worth minimum to be able to participate in a fund that has 13 managers that somebody, the mass affluent, wouldn't have access to any of those on their own. But now they're being provided access to it. They're being provided diversification. They're being provided one K1 instead of multiple K1s. And so I think that transition is going to continue. A lot of the big private equity firms are coming out with portfolios now that are available to accredited investors, where there used to be, not only available to QP only, but the minimum to get into them used to be really high, and now it's the barrier to entry is continuing to go down. So I would suggest that trend is going to continue, and that there's not going to be as much dependency, if you will, on the traditional stock market investments.
Gotcha. I like that.
Yeah, I like that as well. And to wrap things up here, there's just one final question I like to ask people on this podcast. I want to ask you, how do you measure success as a financial advisor, as a leader, however you want to view that question?
That's actually, it sounds like an easy question, but it's not an easy question.
Yeah.
It's a loaded one. I know.
Yeah.
So I like to save for the end.
Yeah. I mean, I think as a firm, we measure success on our ability to reach our goals, which, because of the systems that we use to track our goals, we're a very goal-based firm, and we're constantly staying on top of those goals. So I think success for the firm is really about us meeting goals. I think more so for me, and I think this would apply to a lot of individuals within our firm, but I measure success by value creation. Whether it's creating value for our clients because of the offerings that we have, whether it's creating value for our clients because we give them the peace of mind and security that they need so that they can live their life the way they want to and not worry too much about their overall financial affairs, or even just the giving back principles. Last week I spoke at my high school alma mater. It's the second year in a row that I've done this, but I'm speaking to I was speaking to separate classes that are in a preparation for college type class, and they wanted me to come in and talk about my story and going through to college and starting my own business. And I got done doing that after several hours, and I just felt just a huge sense of satisfaction that you never know if one thing that you say to a group of 17-year-olds is going to stick, but if there's one person in that class that something that I said has an impact on them, whether I ever know that or not, I still feel very good about that. So that's having the ability to do that and make a difference in other people's life is my personal measure of success.
Great. Thank you.
I like that. And, I like that they had you go in and talk to those kids in high school, because I feel like in high school and even in college, they don't teach financial literacy enough, how to wisely spend your money, go into college, opening up all these student loans. Next thing you know, you're in so much debt, but that's awesome.
Yeah.
Well, Thomas, it's been an absolute pleasure speaking with you today. Thank you so much for sharing your experiences and insights with us and our listeners. We really appreciate it.
It was my pleasure to be here, and great talking to you too as well. And thank you.
Thank you.
Thank you. And to all our listeners, thanks for tuning in to another episode of the What Matters podcast. Stay tuned for more insightful discussions in our upcoming episodes. Goodbye for now.